Hey, hello everyone. Welcome to our final installment of the year of our webinar series, New York State and Local Tax of Mind. This is our annual year in review presented by myself, Jennifer White, Aaron Young, Jeremy Gove, and George Soflius. So before we get started, I just want to go over a few housekeeping items. At the bottom of your audience console are multiple application widgets. If you have any questions during the webinar, you can click on the Q&A widget and submit your question through the chat box. If we don't get to your question during the webinar, we'll follow up with you after the program via email. Additional materials are available in the resource list widget that looks like a red folder at the bottom of your screen. You can find a copy of the program slides there. If you have any technical difficulty, please click on the Help widget. It has a question mark icon and covers common technical issues. Throughout the webinar, you'll see several polls pop up on your screen. The reason for these pop-ups is that the program is eligible for CLE credit in the jurisdictions listed on the invite and registration. In order to ensure that you receive full credit, please click Confirm and Submit button to remove the pop-up. You'll have 2 minutes to do so. A recording of today's webinar will be available approximately 1 day after the program and can be accessed using the same audience link that was sent to you earlier. So with that, we will begin our presentation today. So for our year in review this year, we thought that it might be fun to do a little top 10 of issues and developments that have occurred in New York over the past year, which we think everyone should be aware of. Either the impact that has played out in 2020, or things that we see teasers of what we envision will be important rolling into 2021, and will probably take up some attention of taxpayers in the department. We've got an assortment of things here. We couldn't possibly do a year in review without mentioning COVID and New York's response and the impact on New York. We've got a few cases, some ALJ, tax tribunal decisions here that will probably impact taxpayers in regards to sales taxes and some corporate income tax issues. A quick discussion of some legislative proposals that we're probably going to see come out next year. The draft regulations that are still pending, but we're seeing some updates come through, and some other just general, more informal updates and changes that we've seen coming out of the department. So I will kick it off to George for our first of our top 10.
Thanks, Jen. So we'll begin with a recap of some of the state and local tax implications of the COVID-19 pandemic and the resulting stay-at-home and other executive orders, which have closed offices, restaurants, and retail stores, among others. Recent estimates show that New York State will lose over $20 billion in tax revenue over the next 4 years. And the state itself has projected revenue shortfalls upwards of $59 billion through 2022 as a result of the pandemic. These shortfalls, of course, are a direct result of drastic dips in collections of taxes, such as sales tax and fuels tax, and projected dips in collections of these taxes, as well as personal income tax and corporation taxes. As a result of these revenue shortfalls, we expect to see legislative proposals and executive responses in the state and city's budgets for 2021 to 2022. Some potential options for the state and city include broadening the sales tax base, legalizing and taxing marijuana, reducing tax credit programs. Some proposals that are also under consideration include increasing tax rates for those ultra high net worth individuals, which could potentially bring the combined state and city tax rate upwards of 15.7%, imposing a tax on second residences within the city, imposing a stock transfer tax, and imposing taxes on digital advertising. So those are just a few of the proposals that are out there. We'll continue to keep track of these proposals, and we'll be discussing them during future webinars in the months ahead. We also wanted to share just a procedural note as this has come up in our own practices. While there were temporary authorizations in place to accept electronic signatures on certain tax documents, the use of an electronic signature is not accepted on a power of attorney. So next, Jeremy will provide an update on the MarketShare Partners decision from earlier this month.
Thanks, George. So second on our list, and I would have to be humble, first in my heart, is the matter of MarketShare Partners, which was a case released by the Division of Tax Appeals about a week ago. And this was a case that I successfully litigated along with our former colleague, Greg Roberts. And the issue in this case was whether the taxpayer's sales were an information service or pre-written computer software, both of which would have been taxable. And during the periods in issue, MarketShare was engaged in 4 distinct separate lines of business. The marketing analytics consulting for advertisers, the same service, marketing analytics consulting for media companies. They provided access to a remote software platform for advertising agencies, and they also sold white paper research services. And this determination is lengthy. It's about 55 pages, and the facts are really important. And so we're going to spend some time just really digging into those because they become pretty important to really contextualize what the ALJ determined. And so for the marketing analytics consulting service for both advertisers and media companies, the department contended that this service was a taxable information service, and MarketShare took the position that it was in fact a non-enumerated, non-taxable service. And it was a consulting service that customers used to answer their most difficult marketing questions. For example, how to allocate their marketing budget across different mediums, geographic regions, product lines, etc. And crucially, the marketing analytics consulting service was conducted in 4 distinct stages. It was first was goal alignment, second, data collection and processing, third, model development, and fourth was providing insights and presenting those insights. And so we're going to take a second to kind of look at all 4 phases because Judge Connolly's determination walks through these in quite a bit of detail. And so I think it would, from a 1,000-foot view, benefit everyone to at least understand how we got where we did. And so during the goal alignment phase, MarketShare's consultants would meet with the customer's key stakeholders and determine what questions the customer was seeking to have answered. And during this, MarketShare's employees that were involved were data strategists, data management engineers, marketing consultants, and statisticians. And for advertisers, this stage was about how to answer their marketing questions regarding products that they were advertising versus media companies. It was about the media company kind of demonstrating the efficacy of their platforms and showing to advertisers how different properties that the media company owns, whether linear television, websites, things like that, performed for specific advertisers or categories of advertisers. Second, during the data collection and processing phase, MarketShare collected, processed, validated data that it used to build models, which helped inform their insights and recommendations that they ultimately provided to the customers. And while most of the data was customer specific, and in fact much of it was the client's own data, some of it came from third parties such as Google query volume, social sentiment data, and some of it was just publicly available macroeconomic data such as the price of gasoline and weather. And each client's data was put into a separate database, and even if the data, the macroeconomic data may have been responsive to multiple clients, it was retrieved each time for that client. And so the macroeconomic data might have been used to kind of isolate certain other variables, such as gasoline and auto sales. Was the dip in auto sales due to marketing, or was it in fact due to a spike in the price of gasoline? And in the third modeling phase, it was at this point that MarketShare statisticians and data engineers analyze the data to spot trends, correlation, and multi-collinear variables. And so these models that they used and developed are nonlinear regression models, which were uniquely built for each client. And to kind of understand what these models were is they're essentially an equation that shows the relationship between certain types of marketing and advertising expenditures and whatever you're trying to measure, so the sales of the product being advertised. And finally, the last phase of the engagement is the insights, the presentation, where the customer actually gets what they engage MarketShare for. So customers don't receive these models that MarketShare develops, but what they actually get is MarketShare comes and presents its specific recommendations through various in-person meetings that have been informed by the model and the analysis that they've done of the model and the data. And the engagement really culminates in MarketShare telling the customer what to stop doing, what to start doing, and what to continue doing in order to achieve the desired results. And MarketShare does provide its customers with access to a software tool which reflected the insights generated by the model, and it allowed for certain scenarios to be able to be run so that inputs could be adjusted and customers could see the change in corresponding outputs. And typically, MarketShare's consultants that worked with the customers on each of these engagements were the ones using the software, but the customers did have access to it. And to kind of wrap up, the advertising agency product is a software platform that is purely access to a remote software program that advertising agencies use to help them in advising their clients, while the white paper research services were custom analysis of an issue, oftentimes using the same phases of the engagement of the marketing analytics consulting service, but rather than providing a presentation at the end, a white paper was provided. And that is a lot to digest. And so I think that to really understand what the determination said, we needed to lay the factual background. And the determination dealt with all four of these services separately, but I think that as the marketing analytics and consulting service for advertisers and media companies is essentially the same service, we will deal with them together. And for that service, the ALJ determined that the service was a non-taxable, non-enumerated service rather than an information service. And I think crucially, and this is where there start to be some takeaways for other taxpayers, that when determining a service's primary function, one must look beyond the labels and description and examine the company's actual functions and what the customer actually was engaging the vendor to provide. And I think another takeaway here was the ALJ carefully went through each contract with each of the advertisers and with each of the media companies and noted that the witness's testimony and the contract as a whole left little doubt that the services go well beyond providing access to the software tool or the provision of information. And for example, MarketShare worked with the clients to develop questions and come up with answers to those questions. And as Judge Connolly noted, it'd be puzzling if what the customer actually wanted was just the underlying information, because then why would you go through the trouble of having MarketShare develop these questions with you and then embark on this lengthy engagement to answer those questions? And further supporting that conclusion, the ALJ cited to the contracts in detail, and it made clear that the advertiser customers were looking to MarketShare to help them kind of make the jump to this new type of data-intensive marketing. And it is really the language in the contracts and the testimony working hand in hand that provided the ALJ with the sufficient evidence to be able to come to the conclusion that this wasn't a taxable information service, but was in fact a professional consulting service. And as I said before, there was one contract where this marketing analytics service that was found otherwise non-taxable was held to be a taxable information service, and it gets back to the contract, because for one of the engagements, the contract didn't specify all of the professional services that were part of the other contract, and instead appeared to be more of just an information service. And so that's where the breakdown came from, the rest of the contracts being found to be non-taxable and one being taxable. And kind of hand in hand, the white papers were determined to be a taxable information service as well, because the contracts, again, didn't lay out in specificity the services that were being provided versus the contracts that we previously discussed for the marketing analytics consulting service. And finally, just quickly, the advertising agency product was found to be the remote access to software, and the license to use remotely accessed software was found to satisfy the department's constructive possession regulation, and finding it to be taxable is in line with long-standing department policy. So I think that some of the takeaways that we've already mentioned are that these contracts are very crucial, and so each time taxpayers engage in the provision of a service, they should think about carefully laying out what's actually being provided, because the contracts were cited at length in this decision to support the determination that the service was non-taxable. I think also this likely does not mean that all data-driven services are now professional services, so taxpayers should keep that in mind when drafting these statements of work to really accurately illustrate what is being provided. And lastly, the personal or individual exclusion for information services is that exclusion, as depicted in Wegman, is alive and well, and Judge Connolly actually went on at length to note that were this found to be an information service, it would be taxable and the personal or individual exclusion would not be satisfied. And just quickly, a TSB on a similar advertising service was recently issued where a taxpayer provided digital marketing services, and the department went on to find that that was a non-taxable advertising service. And so I think that as more and more of the economy shifts to services, I think that it's incumbent on taxpayers to really think about that as they draft these contracts, because as we've seen, it's the contractual language that will carry the day in these sales and use tax disputes.
All right, thanks, Jeremy. I think that segues nicely into our third, our top 10 list today, which is a string of various digital advertising and internet tax proposals that we've seen come out of New York in the past year. Nice relation to the MarketShare update Jeremy gave, because, we are seeing the state the past few years be a lot more aggressive in trying to use the tax on information services to grasp at, what we've always thought of as other revenue streams, whether they be some professional services, or we're seeing, various kind of new age advertising services, which we historically think about as not being taxable, but the department's trying to grab onto. So we have seen, between 5 and 10 different proposals come out of New York this year, seeking to impose tax on various digital advertising services. They all look a little bit different. We've seen ones that come in the form of a separate tax and only would apply to the largest players, after about $100 million, companies with $100 million in revenue, with gradual tax rate increases for increasing amounts of revenue. So obviously those would really hit just the biggest players in that space, and would, go after advertising that uses personal information of the target. So, we all think about now as, Facebook advertising and, Google advertising that's using our personal information. Then we've seen some other broader ones come out as proposals that have, sought to expand the sales tax base and would impose tax on advertising more broadly. We've seen separate taxes proposed that are an additional tax on gross income. Most recently, we actually saw an internet tax proposal be floated, which actually would be on internet broadband providers. Certainly some concerns there about how it would interplay with the Internet Tax Freedom Act, but I don't think anyone's gotten that far to really even raise those concerns formally. But I think the important takeaway here is to keep an eye on these going into 2021. I think that with the budget deficits, it's very possible that we could see some of these come out in the governor's executive budget proposal. There were proposals like this that made their way pretty far in Maryland and then wind up being vetoed by the governor after passed. That in Maryland is probably going to come back to light in January, February of next year. We're seeing other similar proposals in Nebraska. One was just proposed in Washington and generally around the country. So it's a trend. It's unfortunately a national trend, and I think that we can expect to see that over the next few years some of the budget deficits may be filled in by digital advertising or, quote-unquote internet taxes. So definitely keep your eye on these.
Thanks, Jen. So number 4 on our list is a recent case that came out of the New York City Tax Appeals Tribunal. Mars Holdings came out in June of this year. It's an interesting case regarding the taxation of a gain on the sale of passive non-unitary partnership interests. New York City has a general corporation tax that is substantially similar to the New York State corporation franchise tax. It's an income-based tax. They use the same definitions. The statutes are substantially similar. Appeal procedures are very similar. So most taxpayers that have New York State liabilities will have New York City liabilities and vice versa. The difference being just the apportionment for the city obviously would be different than the overall state apportionment. But in this case, it was a taxpayer that was a New Jersey-based company that owned through joint ventures interests in several limited partnerships that had business activity in New York City. And it was the taxpayer's only connection with the city, but because it had these passive partnerships that were operating in the city, they were reporting New York City general corporation tax, and presumably based on their distributions, they would apportion it to the city based on the K-1s and the partnership's connections with the city. The issue is when they sold the partnership interest, there was capital gain, and which was recognized for federal purposes, and the taxpayer took the position to exclude that gain from their New York City entire net income base based on the position that was gained from an intangible that should be sourced to corporate domicile, which in this case was New Jersey. So in essence, the taxpayer was arguing that it was a non-unitary passive interest, and that it itself was not conducting business in the city, although its investments were. Even though that gain was included on the federal return, the taxpayer argued that based on federal tax law guidance for tax years prior to the 2017 Tax Cuts and Jobs Act, sourcing of intangible receipts, such as the partnership interest at issue, should go to corporate domicile. And that was based on another federal tax case, City of Grisha Magnesite, which is a 2019 case regarding redemption income, where income was sourced to the residence of the taxpayer, which in this case was foreign source. So you will have cases regarding sourcing for federal purposes with U.S. source versus foreign source, and that's what that case applied to. So the taxpayer basically took that guidance and applied it to its New York City general corporation tax, and said that under federal conformity, it should be sourcing to its corporate domicile, this gain from the sale of the partnership interests. The New York City administrative law judge, which is the first sort of formal level of appeal after the conference level in New York City, found that nexus was established through the holding of the partnership interests, and this was consistent with the taxpayer's filings over the years, where it reported general corporation tax on its distributions from the partnerships. And it also found, the administrative law judge found, that there was nothing in the New York City tax law that would allow the exclusion of the gain, and that under City Code Section 11604.8, the tax commission can adjust and affect a fair and proper allocation of income reasonably attributed to the city. An exception for this case was filed, and in New York City, the appeal procedure, similar to New York State, where the first formal level is the administrative law judge, called the Tax Appeals Tribunal in the city. It's called the Division of Tax Appeals in the state. The next level is a panel review of administrative law judges. So this will be at the Tax Appeals Tribunal in New York City before a panel of judges to review the lower board's decision. So some questions that come up from this decision are how sort of constitutionally the city can tax this type of gain when you consider pretty clear, significant, major U.S. Supreme Court cases regarding taxation of non-unitary income and gains, including cases like Allied Signal, Midwest Vaco, and other cases that have come out over the years regarding proper apportionment and the taxation of non-unitary gains. So this one's to keep an eye on. There is also a few other cases in the city that are behind this case that are also moving through the appeal process. So if you have issues regarding passive investments, particularly partnership interests, that would be non-unitary with income and gain associated with those, and again, it would be either state or city, since the structure of the tax in both the state and the city are very similar. So typically, if a taxpayer has an issue in the city, they have one in the state as well. So you should keep an eye on these cases to determine whether or not tax is due on this type of non-unitary gain.
Thanks, Aaron. We now move to number 5 on our list, which is 2020 draft regulations. So earlier in the year, New York had released 2 sets of draft regulations for comment. In May, the state released its draft regulations on Part 10, which includes definitions and tax computation rules for qualified New York manufacturers, corporate partners, New York S-Corps, real estate investment trusts, regulated investment companies, and domestic sales corporations. We found the draft regulations on qualified New York manufacturers particularly notable. These regulations appear to go beyond the text of the statute and impose additional requirements on taxpayers to qualify for the preferential tax rate. Specifically, while the statute defines a qualified manufacturer as a corporation engaged in the production of goods, the draft regulation would require such corporations to produce tangible goods. The draft also expressly excludes certain types of manufacturing activities, such as creation of digital products, the manipulation and transmission of information, and processes which make items more attractive for sale without substantially altering them. These are among others. These draft regulations would also impose greater burdens on companies that contract out their production activities. In July, the state released its draft regulations on subpart 3-10, which addresses net operating losses and net operating loss deductions for tax years beginning on or after January 1st, 2015. These draft regulations provide that taxpayers who filed federal returns on a consolidated basis, as part of the consolidated group, but who filed their New York returns on a separate company basis are required to compute their NOLs and their NOL deductions as if they'd filed their federal returns on a separate company basis. The draft regs would also provide that NOL deductions for tax years beginning on or after January 1st, 2015. It's not limited to the federal NOL amount, but such deductions would have to be determined using the same federal limitations for acquired or merged loss companies. Finally, we wanted to note that the city has indicated, a change of course in that it may proceed independently from the state's regulatory process in promulgating regulations related to the 2015 corporate tax reform. New York City had specifically indicated it would wait for the state regulations to become final and then move them through their own system. But it seems as if we're not the only ones growing impatient. We've heard from the city that it's looking to take some independent action and potentially try to roll out their regulations sooner. No promises, but we'll see how that unfolds in 2021. So next, Jeremy will provide an update on the city's commissioner.
At number 6, New York City has a new commissioner of the Department of Finance. On November 1st of this year, Jacques Jiha moved from his role as the commissioner of the New York City Department of Finance to the mayor's office of management and budget. There, he is tasked with overseeing New York City's $88 billion budget, and much in the same way that he has been with the Department of Finance, will help the city continue to navigate the myriad effects COVID-19 has had on the city's finances. Jiha's time as commissioner began in 2014, so his experience will be missed as he oversaw the department's institution of corporate tax reform that George just touched on, and which has really been a continuous effort. And so hopefully those New York City regulations will potentially continue even as he moves on. Mayor de Blasio has yet to select a permanent replacement at this point. In the interim, Michael Hyman has been the one that's tasked with serving as the acting commissioner. And by way of background, Mr. Hyman is a veteran of the Department of Finance, having been there since 1988, and most recently serving as first deputy commissioner since 2015. He's previously served as the deputy commissioner for the Tax Policy and Planning Division, which included tax audit and enforcement and tax policy, two pretty hot button areas for taxpayers to interact with the department. Mr. Hyman has long been involved with tax policy matters, given that he has overseen those two divisions, including playing a large role in the institution of the 2015 corporate tax reform, as well as changes to the city's audit selection process. And given his breadth and depth of experience with the department, we'd anticipate that things will largely remain the same as they have been, and taxpayers shouldn't anticipate any radical changes in regard to how the department operates. Seventh on our list of top 10 things taxpayers should be aware of from 2020 is a decision by the Tax Appeals Tribunal from back in May, which is the matter of TransCanada facility. And the issue in this case is whether the taxpayer was subject to the qualified New York manufacturer cap of $350,000 for purposes of computing the capital base of its corporation franchise tax liability. And by way of background, TransCanada provides wholesale electricity through its wholly owned subsidiaries, and the years in issue, which were 2010 through 2012, TransCanada filed combined returns with one of those subs and reported the tax of the combined group using the capital base amount, which was capped at $350,000 per year, as TransCanada's capital base yielded the highest tax on the grounds that it was a qualified New York manufacturer entitled to use that liability cap. And that really became the issue in this litigation. And the department issued a notice of deficiency, which TransCanada appealed to the DTA. At the DTA, the ALJ determined that TransCanada was not entitled to the qualified New York manufacturer cap on the capital base. And so TransCanada filed an exception to the tribunal. And there were a couple of different arguments on exception to the tribunal, one of which was whether the capital base is an imposition statute, and the second of which is whether the definition of qualified New York manufacturer for purposes of the capital base definition refers only to the investment tax credit language and thus allows the generation of electricity to satisfy the requirements of being qualifying manufacturing activity. And so first, as to the question of the imposition statute, the tribunal recognized that the language in the capital base tax cap is, quote, functionally distinct from an exclusion, exemption, deduction, or credit. And the tribunal found that the cap was not an exemption because it didn't serve to make some or all of TransCanada or any other taxpayer that was using the cap property not taxable. It's not a deduction because it didn't provide a fixed amount or percentage that the taxpayer could subtract when computing its taxable income. It's not a credit because it didn't apply to the tax that would have otherwise been due. And finally, it wasn't an exclusion because it doesn't act to exclude property or income from tax. Instead, the tribunal found that it imposes a limit on the amount of tax that a taxpayer owes, which led to them finding that as it is an imposition statute, which is construed most strongly against the taxing authority, the capital base statute should be construed against the government and in favor of the taxpayer. And to the second question regarding the definition of qualified New York manufacturer, that one got a little bit more attention and was a little bit more thorny given some of the language and how it was used across different statutory provisions. And so the tribunal looked at whether the taxpayer generating more than 50% of its receipts from the production and distribution of electricity qualified the taxpayer to be a manufacturer. And a manufacturer is one who's principally engaged in the production of goods by manufacturing, processing, assembling, and several other similar activities. But crucially in that definition is not the production of electricity. And so the question became whether the generation of electricity is an activity that qualifies as the production of a good. The department contended that the definition of manufacturer for purposes of the capital base cap originated in the investment tax credit provisions of the tax law, section 210.12, and that section explicitly excluded electricity from the term goods. But while seeming dead on its face, the tribunal disagreed with the department's argument. And to get there, they noted that when the legislature added the definition of manufacturer to the capital base section in 2005, the legislature made a proactive choice to use language that the tribunal had previously interpreted did include the generation of electricity, but chose to abandon or leave behind the specific exception or exclusion regarding the generation of electricity. And so electricity should be included in that definition of manufacturer. And the final question revolved around whether the investment tax credit limitation sentence in that former section 210.12 serves to prohibit the taxpayer's electricity generation facility from serving as qualified property for purposes of the taxpayer meeting the property portion of the qualified New York manufacturer test. The tribunal once again agreed with the taxpayer, and the tribunal found that the qualifying property for purposes of the capital base liability cap looks to the definition of property in the investment tax credit subdivision, and the tribunal agreed with the taxpayer that the limitation excluding electricity from the language we just discussed in section 210.12 only applies for purposes of the investment tax credit provision, but has no effect for purposes of defining a qualified New York manufacturer when determining the capital base liability cap. And the tribunal conceded that the statutory language was not clear and unambiguous as we've gone over. It's certainly not clear to me. And so it buttressed its conclusion by relying on the legislature's intent, as well as by looking to legislative proposals, some of which were never actually adopted. And some of the takeaways from this are that while this is obviously a great win for the taxpayer, this is likely a harbinger of things to come. This case was for tax years 2010 through 2012, long before the much discussed zero rate for qualified New York manufacturers. And so we suspect this is likely going to be the first of many cases that analyze different aspects of the qualified New York manufacturer provisions. And while this case may not necessarily present a roadmap for other taxpayers to follow in order to achieve the same result, the facts are a little quirky, addressing the taxpayer's electricity generation facility, and those don't necessarily act as guideposts that every taxpayer should follow. I think that it does provide some lessons that taxpayers should be cognizant of in attempting to initiate litigation regarding the qualified New York manufacturer provision and achieving the same result. And I think one of those really crucial things is the importance of statutory construction and the development of supporting legislative history, as that was one of the aspects that helped carry the day on the qualifying property issue. Ultimately, while each case may not look like TransCanada, what this case teaches taxpayers seeking to litigate the qualified New York manufacturer issue may actually be invaluable.
Yeah, I mean, piggybacking off of what Jeremy said, I think that that's right. The TransCanada cases, limited to certain years and there's certain fact pattern. But I think it is important that when following through the guidelines of exclusions in particular to taxability in any area of the law, specifically when it pegs to other sections in law, it's important to look at how the other sections interplay with the exclusion or exception in the law. I think there's certainly other areas of the law that we could point to for sure where this gives us some guidance to say, hey, the exclusion isn't necessarily as broad as the department has otherwise thought it should be. And there's certainly some opportunity there for taxpayers and related industries. So if you're in that industry, definitely worth thinking about and seeing if there's opportunity. That being said, number 8 on our top 10 list, I think we would be foolish not to mention a little bit of, telecommuting guidance and issues in 2020, where, for better or for worse, most of us have been working remotely for the majority of the year. Historically, companies didn't like remote workers because they create, complicated tax issues for all different types of taxes, withholding, of course, personal income taxes, corporate tax nexus, sales tax nexus, although probably a little bit less of that these days in light of Wayfair. Personal property tax issues could impact, the ability to meet the qualifications of certain credits and incentives that have been granted. So remote workers were complicated and not well liked, but every company is grappling with how to handle those this year. Probably the most, popular issue that's been talked about is withholding tax for telecommuters. As a way of background, New York generally imposes a personal income tax based on where the work is performed, and that is, correspondingly how employers are expected to handle withholding tax. However, New York has, for many years had what they call the convenience of the employer doctrine, whereby individuals who basically choose to work from home nonetheless have their income source to the place that they work from. So I work in Manhattan. I live in Connecticut. Historically, my days working at home in Connecticut were still treated as New York work days for purposes of sourcing them for withholding and personal income tax purposes. How New York got there, there's a regulation, and we've included that on the slide here, but it basically says that the last sentence, any allowance claim for days worked outside of New York must be based upon the performance of services which of necessity, as distinguished from convenience, obligate the employee to out-of-state duties. So they were really only treating days worked out of the office, as sourced elsewhere to the extent that it was necessary. There has been 2 versions of a TSBM that were put out 2015 and 16, where New York provided guidance on basically what that means. Long story short, the guidance that's been out there since 2016 says that you need to look to basically if there's a bona fide office at the place where the employee is working from. There's a number of factors, a primary factor and then a few secondary and other factors, and if you have, a certain number of each combination, then it would be deemed that you had a bona fide office. And then those days could be treated as basically non-New York working days. So the big question for all employers was, how do these rules, interact with statewide closures, with, office closures, mandatory work from home orders. There's been an assortment of those that have changed over the course of the year. There hasn't been statewide mandatory closures, but there's been, the practical issues and employers saying, hey, don't come to work. So, if you're an employer, you should be satisfied that in October, finally, the department issued some guidance on this through a frequently asked question on their website, where they basically said that telecommuting days during the pandemic are considered days worked within New York unless your employer has established a bona fide employer office at your telecommuting location. So they basically say, hey, the TSBM applies, go back to those rules. If you have a bona fide, home office, then it can be treated as, sourced outside of New York, but otherwise source that income to the New York office. So that works for employers. That's a rule, that can be followed. And for withholding tax purposes, I think that's what, withholders need. However, I will say that for individuals, to the extent that this, this rule has an impact, significant enough on what your personal income tax liability is, I think there are holes that can be poked in this position. The state's guidance pegs itself to the TSBM, which of course drives its authority from the regulation. But if you look at the regulation, right, it just talks about what days are from necessity as distinguished from convenience. I think that there is a pretty strong argument that work from home days for at least a large portion of 2020 were out of necessity and not just for anyone's, convenience. And arguably, therefore should not be sourced to New York if the location of work was actually outside of New York. So, our takeaway, here's the guidance that employers needed when trying to figure out how to handle withholding. But if you are an individual, you have, highly paid executives that are trying to figure out their personal income tax position and, you work with them on that, certainly something to think about because I think that this frequently asked question is, not necessarily consistent with regulations, and I'm not sure that it would hold up, if challenged in the administrative and state court levels of New York.
So we'll move next to number 9 on our list, which is New York's response to Notice 2020-75. So last month, the Treasury Department, IRS, released the IRS notice, which addresses the $10,000 state and local tax deduction limitation imposed by the Tax Cuts and Jobs Act, which applies to taxable years between 2017 and 2026. The notice announces forthcoming proposed regulations, which would clarify that certain payments, which they call specified income tax payments, are deductible by partnerships and S corporations in computing their non-separately stated income or loss. The notice defines these payments as, quote, any amount paid by a partnership or an S corporation to a state or a political subdivision of a state to satisfy its liability for income taxes imposed by the state or political subdivision on the partnership or the S corporation. This proposed clarification constitutes broad guidance that enables, workaround to the SALT deduction cap that shifts the burden from individual owners, back to the business entities. There's mounting pressure for New York to provide, at a minimum, an elective tax in order for partners and shareholders to benefit from the notice. A proposal addressing this elective tax is likely to be included in the governor's 2021 to 2022 budget early next year. We note, though, that it's unclear how the resident credit portion will work. To date, instructions assert that no credits will be given for similar taxes paid to other states that already have enacted the scheme. Those states are Louisiana, Oklahoma, Rhode Island, Wisconsin, New Jersey, Maryland, and Connecticut. and we question whether this is consistent with the statute.
Yeah, I mean, this is, good news for New Yorkers. Obviously individuals, in New York were pretty negatively impacted by the $10,000 limitation for the SALT deduction. And since then, the state has been pretty active in trying to, work with taxpayers to figure out, if a workaround, was possible. And one of the options that had been on the table was an entity-level tax for pass-through entities with, an owner-level benefit to try and circumvent the deduction. A proposal was put out, at least a draft of one, I think it was in 2018, and nothing had been done with it formally, but this basically gives, broad clearance to say, hey, New York and other states, go for it. The IRS is sanctioning this. So that's a good thing. I think, like George said, we're going to see a proposal come out. I think there's already been, talks of, what exactly it'll look like, that they certainly want to do it. And they basically have, free range to make that entity level tax and, owner benefit, work however they'd like to. There really aren't very many guidelines in the IRS's notice other than to say that, you can't impose basically a retroactive tax to try and give the benefit in years prior than when the tax was actually enacted. So aside from that, going forward, it should be a workaround to help some individuals. And the piece about the resident credit, is pretty important. Hopefully, there'll be some better guidance put out such that, a resident credit, can be taken for all these similar type taxes, paid to other states as well. So I think we'll see more on that pretty soon, and hopefully will be, something nice coming out of 2020 and rolling into 2021.
Yep, and Aaron will next round this out with a discussion of the state's royalty income exclusion and an update on the Tax Appeals Tribunal decision in Disney.
Thank you, George and Jen. So this is number 10 on our list. It's the final item on our agenda for this webinar. This is the royalty income exclusion, and in particular the matter of Walt Disney Company decision from the Tax Appeals Tribunal in New York State was issued on August 6, 2020. I mentioned earlier that procedurally we have formal appeals after the conference level starting in New York State at the Division of Tax Appeals with an administrative law judge. The next level beyond that is the Tax Appeals Tribunal, which is a panel of administrative law judges, very similar to the New York City appeal procedure. The issue with Walt Disney is whether the taxpayer can exclude royalties received from foreign affiliates in the computation of entire net income under the royalty income exclusion, which is a part of, or was part of, the New York add-back statute. So to go back in history a little bit, 2003, New York enacted an add-back statute similar to many states around that time, where certain payments from related entities would be required to be added back to the tax base. So when New York passed its add-back statute, it had something called a royalty income exclusion, which allowed the recipient of the royalty income to exclude that income from the tax base unless such income would not be required to be added back. So to simplify that a little bit, if we had two New York taxpayers, one payee, one payor, the royalty income was added back, in other words, it wouldn't qualify for one of the exclusions, then the payee would not have to include that royalty income in the tax base. And the exclusions in New York were similar to other states: the conduit exclusion, foreign treaty exclusion, tax paid exclusion, etc. So in the case of Disney, they had foreign affiliate royalties, and they took the position that they qualified for the exclusion, the New York taxpayer did, because the royalties would not be required to be added back under the royalty income language would be required to be added back if they were a New York taxpayer, and therefore, since being a New York taxpayer shouldn't be determinative of whether the exclusion was valid, the payee, in this case the New York taxpayer, could exclude the royalties from their New York tax base. The Tax Appeals Tribunal, which was handling the appeal from the Division of Tax Appeals, which found in favor of the state that the taxpayer was not entitled to this exclusion, rendered its decision in August of this year, and it found that it upheld the Division of Tax Appeals Administrative Law Judge and found that Disney was not entitled to the exclusion for several reasons. The primary being that their view of the statute was that to qualify for the exclusion, the payor also had to be subject to tax and actually added back the royalty income so that the payee could qualify for the exclusion. They also found that the legislature did not intend for this exclusion to apply if the payor was not a New York taxpayer. And they also found that because the payee and payor had the same economic interest, that there was no violation of constitutional issues such as Commerce Clause or Foreign Commerce Clause. So we have the Disney case, which again has been determined by the Tax Appeals Tribunal in favor of the department, and is currently on appeal now at state court, which is the next level of appeal in New York, State Court Appellate Division. That was filed very recently, just December 3rd of this year, just a few weeks ago. There's also a few other cases that are pending for New York State purposes, including an IBM case and a Moody's case, which are a little behind the Disney case in that we don't yet have decisions from the Tax Appeals Tribunal on those cases. There are also potential issues in New York City on this. I mentioned New York City has the same tax structures in New York State, so the same issue can apply in New York City. The primary issue seems to be if the department takes the view that the payor has to be a New York taxpayer to qualify for the exclusion, that there is discrimination in favor of New York taxpayers as opposed to foreign taxpayers. Very similar to the Kraft case, which is a U.S. Supreme Court case regarding domestic and foreign dividends, and it was found to be a violation of the Commerce Clause to favor domestic dividends over foreign dividends. The tribunals and the administrative levels in New York don't typically provide a lot of guidance on constitutional issues, and therefore it's likely there'll be additional guidance from the state court in this case when it ultimately renders a decision in Disney. The issue itself, I guess in essence, goes away in 2013 when New York State and the legislature and the tax department realized that there was some issues regarding its royalty income exclusion and its add-back statute. The law was changed in 2013 for years beginning 1/1/13 forward, where the royalty income exclusion is no longer available. And New York changed its law to be very much more similar to the typical standard UDIPTA add-back statutes going forward after 2013. But the issue is still open, and again, the constitutional issue, which is probably the main meat of the argument, in that it's unconstitutional to interpret it that way in favoring New York taxpayers versus non-New York taxpayers. And since the issue has been appealed, that the issue is still live, even though we do have 3 cases now moving through the process in which taxpayers have been denied relief by the administrative levels. And I'll mention finally again that New York City would have the same issue, and taxpayers should be cognizant of both New York State and New York City and the royalty exclusion and income claims. This concludes our 2020 New York State and Local Tax Update. Thank you for joining us for this webinar. If you have any questions, feel free to reach out to any of us for further information. Our contact information is on the final slide of this presentation. And again, feel free to reach out to me, Jen, Jeremy, or George with any questions about this presentation or any other sort of New York or state tax issues you might have that you think we could be helpful with. Also wanted to mention that Reed Smith's State Tax Group has the largest group of lawyers that practice exclusively in state tax as compared to any law firm in the country. And this includes doing state tax work, litigation throughout the country in all 50 states, but most especially in California, Texas, Illinois, Pennsylvania, New Jersey, the Mid-Atlantic area, Virginia, Maryland, D.C., Ohio, and other states as well. So also please contact any of our Reed Smith state tax lawyers on our website if you have any questions regarding taxes throughout the country, and we'd be happy to try and help you with that. So in closing, happy holidays to everyone, and we are wishing all a safe and healthy holiday season. Thank you.